All right. Good morning, everybody. More jobs data. This is the one that I believe is getting changed, right? The way that they get the numbers. And if you've been around for a little bit and you've looked at unemployment data, I'm pretty sure at some point you've heard the argument of one president saying, look, I lowered the unemployment rate, and whoever's running for president or whoever's on the other team says, yeah, well, you're calculating those a certain way that's favorable to you. Well, they're always calculated in a way that's favorable to the sitting person. And really it's not new, right? But they are talking about changing how that calculation is defined. And if they do, what I've seen is that the unemployment numbers that we are getting right now, for an example, sitting at around 215, 230, they're actually going to cross the 300 threshold. And there is a line in the sand, something at around 265. And when that line gets crossed, it generally doesn't bode well for the marketplace and the economy. So it's a benchmark. Okay, and it's the one that we're getting today, initial jobless claims. The number that we're looking at is 235 as the forecast, and the last number that we had got is 230. Now, the thing about forecasts, depending on where you're getting your forecast, the way that Bloomberg likes to do it is they just get a bunch of different people on their show and ask them, hey, where do you think the unemployment numbers are going to be? I mean, look, that's it, right? They're just asking a couple of smart people, hey, what do you think the numbers are going to be? And then they tally up and they get an average of everybody that they surveyed. What I tend to listen for in the morning of the unemployment claims is their tone and their confidence when they're talking about it early in the morning, not when it's coming out. I want to hear how they are with their projections. And the funny thing is, the more confident they are, the more cocky they are, the more excited I get that they can be wrong. And oh boy, have they been wrong before. So most of the time they're not wrong. Most of the time they're right on and nothing really exciting happens. But when they miss, when they're off sides, that's when the market can really move, because everybody's off sides and they're all scrambling to change and get on the other side of the trade. They weren't really overly cocky this morning. So, I'm not crazy excited, but it's what I pay attention to on the job days. And really, it's the same way for almost any other economic data point that's going to come out. When I hear them talking about it in advance and they're so sure about what the numbers are going to be, I look for what if they're wrong. And that way, at least I'm prepared for the idea that if they are wrong, we're going to do A instead of B. And then I've got a plan in place. So that is the numbers that we really want to watch for today. It's at 8:30. Make no mistake about it. Those have the power and the potential to really rock this market. And when we get to the charts in a few minutes, you're going to see that the market believes the exact same thing, that these numbers, they have the power to move this market. And we can see that. We can see their hesitation. We can see their fear. And we'll get into it. For the moment, we also just kind of want to take a look around at everything else that we have today, because it's a busy day, right? We got a lot of stuff on the table. We do have data coming out of Europe, right? We're going to get their minutes, just like when we get our FOMC minutes. And that's going to shine a light into, how they came to the conclusion that they were going to raise rates, that they just bumped another 25 basis points. So you can see how not only do we have a lot of things on the agenda today, a lot of these are dark red or pretty dark orange, right? So it's just a lot of stuff. And we have additional auctions today. And then tonight, more data coming out of Japan. Now, one thing that we haven't done in a little while that I wanted to stop by and do today is look at what they're doing with the Fed funds rate and what's the projections for the next rate hike. So September 20, it's right around the corner, less than 20 trading days, right? Also, speaking of trading days, next week is a short week. Markets closed on Monday. Keep that in mind, right? We're going to come back on Tuesday. So that makes going into this weekend even more important. It's the end of the month. It's the end of a trading period right before a holiday. So when we come back next week, it's going to be the beginning of the downward move into the end of the year. Now, obviously, we're not talking about like, the 6-month benchmark kind of thing. This is a little more than that. And it's something that right now you're not hearing too much about. But a lot of these fund managers are going to have to prove their worth, right? Why do I need a fund manager if the guy or the gal can't even beat the benchmark? I could just put my money in SPY or the Qs, right? A lot of people use a fund manager. We're going to start seeing performance chasing, and that ties in with the whole idea of the fractal rotation that's going on. So there's just things are going to start to shift, right? Starting next week. And there's been maybe 4 times in the last, let's say 6 times in the last 2 years, where we've been able to point at the chart and say, that's the day right there. That day is when everything changed. We're coming up on one of those. All right, so looking at this for the September 20, we are sitting at 525. Their expectations are that we will still be at 525 after FOMC, meaning that they're going to pause. They could call it a skip. They could just decide to announce finally a pause. Either way, they're not going to raise rates. That's the projection. And they're not going to cut rates. That's the projection. If they do anything, it's expected that they're going to raise rates, that they're absolutely definitely not going to cut. There's not one bid here for a rate cut. So we'll go ahead and jump into November. This one as well shows no rate cut, none. That we're either going to stay paused, which is the highest probability, or that we go up 25 basis points. And then there's the offhanded chance that if we do raise in September and that we're already sitting at 550, that we would hike again into 575. And that's a very slim chance, but that's what that's showing. What's more interesting to me is when I look down at the bottom, how these are changing, right? One day, not too big of a deal. Over 1 week is a much cleaner point of view for me, and 1 month I think is just too far away, right? So maybe the Goldilocks spot, the sweet spot, right around that 1 week time frame. So in the last week, really the only thing that seems to have changed on the November one of real import is that this FAR one on the right has been reduced, and most of the numbers from that reduction came into the idea that we're going to just stay put. And now we finally start to see a rate cut in December. Over the last week, that hasn't changed. Over the last 2 days, or I mean, that's a better way to say it. Over the last 2 days, it's gone down a little bit. But in the last week, we really haven't changed our narrative yet. Yeah, you can find this. Just type in FedWatch in Google and you should find it, right? CME Group, FedWatch. If you search that on Google, you'll find this site. You don't need to log in. You don't need an account. Cool. Higher for longer. That's the mandate out of the ECB, and that they're not done. Now they're they're trying to put a deadline or a cap on the other side, and that reaching their 2% target must not take longer than the year 2025. Good luck with that. All right, so taking a look at what's going on around the world, Hong Kong is down, and this should stand out to you drastically. If there was anything today so far that is a warning, it would be this. Neon flashing lights kind of thing, right? Loud sirens, screaming noise. Hey, what's up with China? Where's that stimulus? Now, they've been doing this kind of offhanded shadow stimulus kind of stuff, right? Just kind of around the edges, making policy easier, making liquidity easier. They got nothing today. Well, there's that new company. It's not new. It's new to the scene, right? Everybody was focused on Evergrande, and now they're focused on this other company. So it's new to the, oh my gosh, we need to watch this space, but it's one of the largest in their space. And now they're talking about default. So it's very likely why we're seeing this down. But take that with a little bit of grain of salt, right? Like, look past that default into the idea that China might actually quit doing the shadow stimulus and get real with it. However that might look. So it's going to be interesting to see if you're long on any of those, JD, PDD, Baba, Baidu, might want to add some time. And if there's one brick in the wall of worry that has a contagion effect that could not just take one market out, but take down the global markets, it would be this one, right? When you think about a financial crisis like 07 and 08, that became a global crisis, right? It wasn't just an isolated event in one nation. This whole real estate thing that's been going on in China has been a global threat for a couple of years now. And for the most part, people just keep ignoring it, like the boy who cried wolf, you know, okay, we're tired of hearing about it. It's a threat, whatever. And it just gets tucked under the rug. But it still has the capacity to be a threat, right? And a serious one. So they're taking it seriously around the world right now. They're not just poo-pooing on the idea that it could be a contagion risk. But if this begins to spread, then that's the real threat. Defaults, right? It's the word that you're looking for. Defaults and contagion and stimulus. If you're looking at anything out of Hong Kong news. Do you remember where you read that? Someone in the comments said they read there's a typhoon headed towards Hong Kong and that their market will be shut down Friday. I'm sure they're going to take anything that they can, any excuse, right, to shut down a day of trading at this point. But no, I'd love to catch the source on that. All right, US dollar Japan still pulling back away from that high that was set earlier in the week. I am on a weekly chart. So while that candle doesn't look that bad on daily, you know, we're down a bit more than that. The main thing is we've got a full stack of moving averages in order from the high to the low. That's the textbook picture of a perfect trend. And we're still above the lowest of the moving averages. So we're still in surge mode. And until we break below at least that white line, then this surge isn't done yet. We take a look at their yield and their lack of control. rather than thinking, that they have their yield control. It's pulling back, at least we can say that, whether it's from intervention out of them or it's just pulling back. Either way, at this point, there's no wick on the bottom of that candle. So we are still pressing to the downside, and we're watching this to see if it is going to break that white line and end the surge that we have to the upside. There was some talk about Mexico changing over and becoming a great trade. But as you can see right now, the best that we can say is that we're holding in this basing pattern. Remember, liquidity resides on the other side of the pivot, so I wouldn't be surprised if we actually get to that 16.5 first. I do see the opportunity to run this back up, right? So, there's a trade here eventually. It's just not yet. So if you're bottom fishing in the FX markets and you're thinking, oh, Mexico looks good, it does. It looks really good for a trade, but it has to offer something first. The best thing that I could say is if you wanted to do it early, that you would have your LRE, right? You'd have your low risk entry. So it's the period in time where you would risk the least amount of money. And that's because waiting for confirmation, all right, now how's the phrase go? You pay for confirmation. You pay for it in risk, you pay for it with a bigger stop. Confirmation just costs you money. And that's the long, hard truth of it. Right? That doesn't make confirmation bad. It just really comes down to the kind of trader you want to be. So getting in near or around this white line here, that 16.62, that's going to be your lowest risk that you could take for this trade. But you wouldn't have any confirmation at all that you're actually in the trade going in the right direction, which would be up. You want this to go up. That's the bet, right? That we're going to get Mexico back up around that $20 range. And that's a nice move. But again, we haven't even started yet. That was a nice pop. All right. It was a nice pop, and it was happening right when I started at 7:30. Before that pop, we had a really tight range bound market, and that shows their fear or their trepidation. There's a smart word so early in the morning. Shows their angst for the data that we're going to get this morning. 8:30, 9:45, 10:30, 11, 11:30, and 3 o'clock. Now, I got to say those farm prices, while I wouldn't discount them, one, the data is going to be coming in kind of late, and two, it's, to me, when I look at grain and everything, I'm more worried about, say, the Ukraine, right? Nations that export or import a lot, say Vietnam, India, right? So this isn't too high on my radar for something that's going to move the markets, but we wouldn't turn our back to it, right? And you can always go over to something like FX Street and see the anticipated impact of any economic data point, including this one, farm prices. So full house today, right? Lots of things. And we got additional speakers today too. We didn't really hit on that enough. But if we go to Finance Juice, we can see that we do have Fed speakers and we have European Central Bank speakers. It's a lot of stuff, huh? All right, so before this pop this morning, we had a very narrow IB, and then price started to do the megaphone thing. The megaphone is where we have a defined range, and then we slowly start to widen that range a little bit more on each side, a little bit more and a little bit more until finally it breaks. And that's what we got. Beautiful break. Inside day breakout to the upside. Now it just has to stick. The problem is with the data that we've got coming out, is it going to stick, right? Like that's the whole point. Our volume this morning is within reason. It's not extreme. One thing of note to me is that there's no market maker move. They weren't hedging for this data point. I am very surprised about that. But even though my expectation was that we would have hedging this morning, the fact that we doesn't throw me off. It just informs me that, hey, this isn't, they're not worried about this one. Okay. I mean, that I can use that, right? It's not my opinion. I'm not guessing. There's no market maker move. They didn't hedge. That's a fact. We take that for what it is and move on to the next piece. If they happen to be wrong, by the way, we're going to see one heck of a move because they're not hedged and they're not worried. All right, we're still building on the classic shape 10-day, 30-minute volume profile with TPO in blue. The point of control is a long ways away. We've got a lot of work to do if we think we're going to get back to it. Like I discussed the other day, we had a classic B shape. And now we're starting to build a capital letter B instead. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. That's just what we expect it to do. This is a wedge, and it is a wedge that's breaking to the upside, but it was a flat top wedge, not necessarily a rising wedge. Although, you know, maybe we could argue that it is a gently sloping rising wedge. And if that's the case, rising wedges break to the downside. The thing that most important to me is this very tight range that we had before the breakout. The initial balance, the IB, the lack of work that needed to be done, and then now this big blowout, as if somebody got the numbers. Now that's not unheard of, right? There's been times before where data comes out and we find out later that somebody had the numbers in advance. We just hit a pretty good chunk of volume up here, like a ceiling. If it had happened down here, we'd call it an iceberg. And now that the move has been made, we can measure the entirety of the move and mark a half back. We can also use that same thing and look for a Busby off of the cog line 45.31. Or we could just look for a continuation. When it comes to a move, generally what you do is measure the move, and then on the completion of the pullback, you plot the measurement of the move to see the next leg. And if it completes the entire distance of the next leg, then the trend is just completely intact and continuing. If it comes up short, we know the trend is slowing down. And if it overshoots that measurement, we know that the trend is picking up speed. It's picking up momentum. We are still outside the weekly expected move, which shouldn't be a surprise, right? Because we haven't gone down yet. But we're supposed to close inside this box 8 out of 10 weeks. And when we counted back the other day, we're nowhere near that number, right? This looks like we're going to get another week outside the box, at least so far. And it goes with my argument that we're very likely going back up to the high of the year. We're going to get back in that general vicinity, right? But we want to be concerned with that halfback measure. So far, we're above the 50% mark. 44.92. That is a level that I'm sure you've heard, and you're probably going to hear it again. We're not done with that level. It's a gamma level. It's a yearly level. It's got all kinds of weight and connotations to it. 44.92. And we're on a daily, which means if we were to go to the weekly, this week hasn't closed above that halfback level yet. So in theory, since the week isn't done, closing above that level isn't a certainty. Here's the weekly with that TRB setup. So the TRB would be the trend line breakover. Generally with a trend line breakover, it owes us back to the top. So we're looking at 45.50 and then we would be done. But that can overshoot to, 4,600, pretty easy. All right, as you would expect with China down, we got KWEB down, emerging markets are down. Financials are close to our benchmark. The XLF is at 0.41 this morning. Our benchmark is 0.5, so it's working in the right direction. Regional banks are closer. It's at 0.45, so a little bit more and it'll be at our benchmark. Bitcoin is up, at least Bitcoin ETF, BITO, and GBTC. Now with that one, with both of those, you have to be careful of what broker platform you're using and go in and check them. Because like Thinkorswim will read after hours data from last night if there's no data from this morning in pre-market. So then, when you're looking at this, you're thinking, oh, wow, it's up this morning, but it might not be. It might only still be up from last night. And then if it hasn't gotten any flows this morning up or down, then we're misled. All right, so we want to go check those. Yeah, that's what I thought. It's not getting any flows here. All right, that's from, is it from yesterday? No, that's from this morning. So, okay, there you go. That's this morning. One single shot at 8 o'clock. BITO has been open or moving around for a little bit longer than that. And so far, it's not looking that great. Right. So that's very likely the just some algo pump. We are seeing a market maker move this morning on a Bitcoin proxies too. So here we've got TrendSpider. This happens to be a really great place to go for pre-market stuff. Just by coincidence, I've already got my crypto list sitting there. So we can see it's a little bit of a mixed bag. Mara, Riot, MSTR, those are down or flat. Had a little bit of bump to the upside, but it's just coming right back down to where it opened in the pre-market this morning. Yeah, and even VITO, you can see how it's giving it back up. So here on the daily, a lot of those are still stuck inside that really big candle, the one that we got when the news came out. So until they get out of that, they're just trapped, and you want to keep track of the 50% mark. $13.91 in VITO. It's going to be that line in the sand. So they're getting some action this morning. It's a little bit of whipsaw. We went from being negative to positive. I'd say watch those today if you're looking for some longs. It looks like we're going to see another attempt to get out of that big candle. So crypto is looking good. All right, here we got Acer. It's not my jam really, but it's the one catching some flows this morning. Acer is up quite a bit, but you can see it's one of those penny stocks, right? So it's not exactly my jam, but we're just looking at what's catching some flows. Let's see, top of the list is the marijuana space. So we can see MJ getting some moves. It's up 1.5% this morning. And this is an ETF, right? So you're going to want to dial down into various pot stocks. Here's my pot list. ACB and Tilray lead the way. ACB getting some pretty good flows. Inside day breakout already. And Tilray, that's a really big move from yesterday. So, you know, it pulled back to the 50%, right? We got that half back, but now it just needs to get out of the box. And XXII, which is one of my favorites, this is more of a real estate, right? But it's real estate for pot companies. It's not doing too good. Yeah, no, it's not doing too good. But I mean, this morning it's got some movement. CGC, I mean, on a daily, that definitely has potential, right? Look, tell me that's not a machine trading that thing, right? Come on. So definitely pot stocks. Energy is right behind that, the USO. And then the Dow right behind that. So we got the dollar. Really trying to come up off of that quarterly level of mine. We broke through it yesterday, got back above it. Now we're setting those higher highs, working our way back up to 103.69. That's going to be a significant level. At the same time, we had bonds working its way up, really tight range. It's got to focus on this inside day breakout. And we've got the 10-year breaking down below the previous day's low. So we've got that disconnect again, right? We had this last week where we had the 10-year going down and we had the dollar going up. Well, we got it again today. This makes it a lot more difficult, right? Because then our tools aren't behaving, they're not functioning the way that they normally would. And we lose a little bit of that edge from the confirmation we get. One of the things you want to watch for today is that these go back into sync, that the dollar and the 10-year start moving together in the same direction. If they don't, find what is moving with the dollar. And it looks like at the moment, if we were just to off the cuff, I would say bonds and stock are moving in the same direction with the dollar. They all three went red there at the same time. Now that's a very overly simplistic example. The dollar isn't even in a breakout yet, right, from yesterday's high, and neither are the bonds. So they're certainly lagging significantly compared to the ES, which has broken out of yesterday's range and is trying to keep that inside day breakout. But something's up, right? Something's off in our tools, and we just want to recognize it, even if we can't put our finger on what's causing it or how long it's going to last. We know that it's not doing what it had been doing, and that's a danger. All right, we can see the financials, not just the XLF, which is a broader financial, but also regional banks. It's interesting that there was a news article yesterday about how Berkshire had bet heavy on insurance for Florida, and that if Florida got whacked really hard by those hurricanes, he stood to lose a significant amount of money. That big storm turned into a big nothing and has been downgraded to tropical storms instead of a Category 4 hurricane. It might have a little bit to do with XLF, which is a financials product, but XLF is a broad basket of financials, including insurance. Knowing that those insurance companies aren't about to, get hit with a lot of claims to be underwritten might be a little bit of a reason for that to be up. I don't know if it's enough, but it at least explains a little bit of it. Not a whole lot going on when it comes to biotech or a lot of these others. There was some talk about Apple with a new product release. I didn't catch the date on that, but if somebody else knows when that's coming out, that would be a good one to kind of keep your eye on. It seems like everybody hates Apple. They love to hate on Apple while it's down even a little bit, but as soon as that thing starts breaking in the new highs, it's everybody's favorite again. So, there's been a lot of talk about it's done. It's had, 3 years of nothing. They're not innovative. They're not coming out with something new. They missed the whole AI thing. And there's a million different articles kind of dragging Apple through the mud. But if they come out with a new product release in the way that they have always done it, meaning they sit back and wait for everybody else to bring out the trash while they perfect something and they bring it out. So I don't know, maybe they're going to come out with something new. Looking at chips, AVGO is up. NVIDIA is struggling. It's up, but not enough to meet our qualifications of up a half of a percent at least. And it is still stuck inside some wide ranges here. So we need an inside day breakout. Psychological level of 500 is so far being just too difficult to get through. If we can get through it, we'll target the top of this big red bar, 510, right? So it's a nice $10 move. We just got to get through that 500 level. It's not looking too hot this morning anyways, but it is catching some bid, and that's the whole idea. We want to see what's moving out there. We don't want a rally in the S&P and in the NASDAQ based on energy and pot stocks. That's not good enough. And while financials is one of the two risk-on sectors that lead a rally, it can't do it by itself, right? So we really need tech at the very least to hold the line and to even better participate in the move. XLK is still kind of down this morning. I mean, it's not negative. It's just not up enough. We had Google with that great breakout earlier in the week. That 133 level finally got taken out with conviction. And now Google's getting outside of that big green bar that all the others have already gotten out of. The thing is, though, that is a magnificent rising wedge. And we know how those break. Eventually. That wedge has taken more than a year to build. So, it's going to take time to fall apart. Look at the push that it's getting this morning. So at least one of the fangs is picking up some flows. Amazon isn't yet. But we do have a beautiful setup here as a TRB. So if we were to snap a trend line there, it's a pretty wide TRB setup. But if we can get a breakover on that, then we could spend 2 weeks working our way back up to that 142.5 in Amazon. Thing is, we're still stuck inside this big red bar. And until we get at least above that 50% mark, line in the sand, we can't consider even a little bit a move to the upside. If we were just using pure price, and since I don't have moving averages on this chart, there's no reason to not use price. We've already got a defined trend to the downside. 2 lower highs and 2 lower lows. That's a full set. So until that changes, we really don't have a top side play. Snow is a part of the FANG group, the NY FANG. It's still stuck inside that big red bar, but it does seem to be through the 50% mark. Getting some bid this morning. It's trying for an inside day breakout. Hasn't accomplished it yet, but it's on the way. Netflix, we're outside of the big red bar and working our way through this big green bar. 437. If we narrow things up a little bit and we just focus on yesterday's level, then we got to get that inside day breakout. And looking at this thing, I'm not seeing any real flows here yet this morning. So it's not getting any attention. It seems like nobody's looking at Microsoft. Nobody's talking about Microsoft. And that's usually when things start to set up really nice, right? They do it when nobody's looking. So I would keep my eye on Microsoft for a play, especially after this downward move. I mean, it was like on rails, right? That was a very controlled, very orderly, very systematic sell-off, and it's done. It stopped. So they accomplished their goal. Think of a big unwind. Some major firm or institution had to unload, whether they liked it or not, for whatever reason. And they slowly and systematically and orderly fashion have unloaded what they needed to unload. And they're done now. We can see that they're done. That doesn't mean that this is going to just shoot right back up again, but I really expect that the move to the downside is done. Now, depending on, your approach, we need to get out of that big red bar. And, since we already talked about it, you got to look at Apple. Apple ain't waiting for nothing. It seems like some insiders already have an idea about this new product launch. It's getting bid nice. Until it pulls back, we don't have our second higher high. So, if we're using pure price with 2 and 2, we don't have it. The problem with using something like a pure price is if this goes into a runaway parabolic run, you never get the pullback, you never get your confirmation, you never get your entry. So you have to kind of adapt in a situation like that and maybe use something else. That quote something else can be as simple as just getting an inside day breakout and then marking 50% of the previous day. And as long as we stay above that level, you continue to stay in the trade. Certainly there's a lot more risk to that, but no risk, no reward, right? Having said all of that, that was an extreme drop after a fantastic run. And if we were to put a fib on it from this low back in January all the way up to the July high, and then we measure this pullback, as long as it is above the 618, the classic textbooks will tell you that it's still fine, right? I'm a little more discerning than that. I tend to want things to stay above a 786 level, but the books say a 618 is fine. At some point, I think I changed this to using quant levels with a 0.75, but it's simple enough to just turn on, if there's still one in here, a 618 level. There it is. So we can see the 618 is at 169, call it 170, and it held above that level. But the argument is, if this is so good, when profit taking happens, you expect others to be happy to take their place, right? Like somebody is happy with their profit, they got out. Somebody else was jealous, they got in. Why did it take so long for everybody to get in on that pullback if it's so great, right? That's the argument for not using the 618. It should never have gotten that far back. And now the concern is that we're actually going to set a lower high off of that peak, and that this lower high down here actually isn't a lower high at all yet. There is a qualification for how many days or how big the leg is. So if the leg isn't big enough, we won't count that as a lower high at all yet. And that would mean we're still going to print a lower high and continue our move to the downside. If you're wondering, the measurement is more than 5%, right? So between 5 to 15%, less than 5 is too little, more than 15 is too much. And then time, it shouldn't take more than 6 months to get that plus 5% in a leg for a daily chart. It all makes sense, right? Hopefully. All right, materials is popping this morning. This is normally one of those sleepy, boring, slow ones that nobody looks at, and it's lit. If we look at it on the daily, this is a really nice scoop pattern. We want to measure like a halfback measure because that's going to be the area of concern. Otherwise, as long as we're through that, this has got the opportunity to reclaim year-to-date highs at the very least. And yeah, we're above the 50% mark. I like it. So what I got for you guys today, be careful, be safe. watch the news on these jobs, and remember that tomorrow is the big one. Tomorrow's the day where we're very likely going to see the greatest amount of volatility and volume before we go into this long 3-day weekend. Everybody be careful. I'll see you tomorrow.